Good evening and welcome. I'm Stacy Murchison, Chief Marketing Officer at Chevy Chase Trust. Thank you for taking the time to join us this evening. We know many of you are spending a lot of time on platforms like Zoom and RingCentral, and we appreciate you logging in again tonight. We hope you are all healthy and safe, and we wish you and your families strength and resilience as we continue to face remarkable challenges in our communities and in our world. Tonight, we do have a terrific program for you. First off, Amy Raskin, my colleague and the Chief Investment Officer at Chevy Chase Trust, will offer her perspective on the current investment environment and update you on some of our investment themes. Amy leads investment strategy, research, and portfolio management at Chevy Chase Trust. Prior to joining the firm, she was Senior Vice President at AllianceBernstein in New York, serving as Director of Thematic Research and Head of U.S. and Global Growth Equity Research. Next, you will hear from Dan Clifton, Partner and Head of Policy Research at Strategas Securities, who will offer his insights regarding the upcoming elections and the potential impact on financial markets. For those of you with questions, they will be addressed at the end of Dan's remarks. We have a few by email already, but feel free to submit your questions during the presentations by using the Q&A tab at the bottom of your screen. Just click at the Q&A button, enter your question in the field provided, and click send. Our program will end promptly at 7:30. So without further ado, I'll turn it over to Amy.
Thank you, Stacey, and good evening, everyone. Thank you for joining us tonight. I'm so glad to be with you, albeit virtually, at this incredibly difficult time. This year has taken a toll on all of us. In one way or another, we've all been touched by the virus that has now taken the lives of over 1 million people globally. Our lives have been turned upside down. We can't go out to eat or go to the movies. Some of us have lost loved ones. Some miss family members too far away to visit without taking the risk of air travel. And many of us are overwhelmed by all the news about a truly astonishing election season. So we're very fortunate to have Dan Clifton with us tonight to help us understand the political aspects of our new crazy lives. But before I turn the microphone over to Dan, I'd like to take a few minutes to talk about the current investment environment and how we at Chevy Chase Trust view the historic disconnect between the economy and financial markets. So I have a short presentation. I'm going to share my screen so you can see my slides. And okay. So here we go. Here's the economic backdrop. During 2020, we witnessed the largest quarterly decline in GDP since the Great Depression, and an equally alarming rise in joblessness. 12.6 million Americans are now unemployed versus 5.9 million at the start of the year. And here are equity and bond market performances. This is not normal. Normally, markets respond to or even anticipate recessions. They don't quickly shrug them off, like we saw this year. But there's nothing normal about this recession or this market response. So let's look more closely about how abnormal this recession is. First, most recessions are caused by economic or financial market imbalances that stem from overinvestment in a specific area or sector. It's a boom followed by a bust. The bust is often hastened by central bank tightening aimed at reining in overinvestment or preventing inflation. This recession was not caused by financial imbalances or inflation. Instead, it was set off by an exogenous non-economic event, the COVID-19 pandemic. Most recessions can be anticipated, though not precisely, because the boom takes time to develop and central bank tightening is usually gradual. Markets couldn't anticipate this recession. The emergence of a new deadly virus is inherently unpredictable, and its rapid spread prompted governments to try to contain it by making us all stay home, virtually shutting down economies around the world. In most recessions, credit is difficult, if not impossible, to obtain. In this recession, central banks around the world flooded the markets with liquidity, and bank lending and bond issuance soared. Most recessions lead to widespread defaults and bankruptcies. In this recession, unprecedented government supports staved off bankruptcies, at least in public companies, and whole industries such as airlines have been saved, again, at least for now. In most recessions, rampant pessimism and panic selling lead to asset prices cratering. In this recession, however, investor willingness to look to better times ahead, coupled with fear of missing out, or in industry parlance, FOMO, has pushed asset prices up. Finally, and perhaps most importantly for our discussion today, in most recessions, low asset prices boost prospective returns following the recession. In this recession, soaring prices have depressed prospective long-term returns for most financial assets. More plainly stated, from this point forward, long-term returns are likely to be significantly lower than historical averages, let alone the past 10 years. The decade from 2010 through 2019 was remarkably good for investors. It began as the global financial crisis was ending and ended right before the pandemic began. The S&P 500's average return over the past decade was over 13% per year. Bonds also performed exceptionally well, with long-term bond returns in excess of 8% per year for the decade. Extended periods of high returns are often followed by periods of low returns. This is not unusual. But how do investors position their portfolios for the best outcome given the highly unusual conditions? Unfortunately, there's no easy answer, because this year's strong market returns were driven, at least in part, by a precipitous decline in short-term interest rates. And all asset class returns responded similarly to the change in short-term interest rates, which are known in financial theory as the risk-free rate. As these charts show, most investments are compared to the risk-free rate. What can investors earn on capital while taking virtually no risk? The return on all other investments must compensate for the incremental risk. When the risk-free rate declines, the returns required by investors on all other investments declines too. When return potential is poor across the board, there's a natural temptation to take significantly more risk to obtain the same target level of return. Undoubtedly, many investors are doing that right now. And we think that strategy is ill-advised. Now is not a good time to move too far out on the risk-reward continuum. Potential returns are not high enough to compensate for the risk of losing capital. Instead, we're putting some capital aside in cash and gold so we can take advantage of better return potential if and when it emerges, most likely as a result of a market downturn. But we're making these moves slowly because it is too difficult to predict exactly when the market downturn will come. Fear of missing out rallies, or FOMO rallies, tend to continue far longer and climb much higher than expected, causing those who sell too early to miss out. Remember 1999? Many investors predicted confidently that the tech bubble would burst for nearly a year before it ultimately did in March 2000. It wasn't fun missing out on the great returns of that final year, and many investors unfortunately jumped back into stocks just in time to lose their shirts when the bubble burst. Instead of trying to time the market perfectly, which we all know is almost impossible to do, we are focusing our research on finding investments that we think will produce superior returns even if overall market returns are low. We're focused on finding the companies that could become the market leaders of the 2020s, as Amazon, Nvidia, and Google have been for the past decade. So where will the next big winners come from? Has COVID changed the list as dramatically as it has upended our lives? Well, yes and no. Many of the next big winners were in our pre-COVID investment themes and benefited from the pandemic accelerating important changes that were already underway. One such change is online shopping. I was an avid online shopper before COVID struck, but I didn't buy my groceries and personal hygiene products online. Now I do. My parents, who are Chevy Chase Trust clients and are on this call, hi Mom and Dad, now buy most of their goods online too. I can assure you that wasn't the case pre-COVID. Without the pandemic, this massive shift would probably have taken years, but this year it happened in just a few weeks. Clearly, retailers were not prepared for this almost instantaneous and very widespread change. How could they be? But at this crucial time, retailers with advanced inventory systems and redundant supply chains were much better prepared to move inventory from stores to special warehouses that fulfill online orders. And retailers without those systems in place learned fast that they needed them. In an omni-channel world, retailers must be able to satisfy a customer order from inventory in any location, whether from a brick and mortar store or a warehouse or their online fulfillment centers or direct from suppliers' factories. And to do that, retailers must be able to locate inventory wherever it might be at the click of a button. If not, they risk losing the sale. In this way, COVID has accelerated the adoption of supply chain automation, one of our 6 investment themes. We think it is also accelerating adoption of automation in labor-intensive services industries, such as hospitality and leisure and food services. For years, hotels, airlines, and restaurants have been trying to automate various functions in order to cut their labor costs and in some cases improve service. Remember when you had to check in for a flight with an agent rather than on your phone or at a kiosk? COVID may now make reduced human interaction a competitive advantage that lets services business increase sales as well as cut costs. As travel, leisure, and food businesses reopen, customers may feel safer patronizing places that allow them to have fewer points of contact with wait staff or check-in services or check-in staff. Automation is also increasing behind the scenes. Robots are now packaging Halloween candy and facilitating food service preparation, and they're even being tested in meat cutting. Remember the outbreaks of COVID in meat packing plants earlier this year? The meat packing industry packs workers closer together than any other manufacturing sector. Each of these industries represents a new end market for our automation-related investments. COVID is also accelerating the realization of our long-standing molecular medicine theme. Despite the temporary cessation of some clinical trials, the pandemic has intensified efforts to understand how genetics impact health outcomes. Why do some people who get COVID have no symptoms while others become fatally ill? What will the long-term impacts of the disease be? To find the answers and bring a vaccine and more effective treatments to market, scientists need to study genomic information and practice molecular medicine. Partly as a result, healthcare research budgets are increasing after decades of cuts. And long-awaited medical breakthroughs enabled by genomic science are finally bearing fruit. Recently, an aptly named company, Grail, announced that it can now diagnose the 12 deadliest cancers in their earliest stages with 70% accuracy from a simple blood draw. In several cases, like pancreatic cancer, there are no existing screening protocols. Since cancer survival rates are directly related to how early cancers are detected, a breakthrough of this magnitude is likely to save hundreds of thousands of Americans a year. Grail is now being acquired by Illumina, the leader in sequencing technology and a longtime holding in our portfolios. Other breakthroughs in gene editing and new cell therapies are now providing cures to formerly debilitating diseases, such as sickle cell anemia, spinal muscular atrophy, and an eye disease called Leber congenital amaurosis. In sum, we think that the leading companies in both automation and molecular medicine themes are going to be big beneficiaries of COVID accelerating well-established trends as the 2020s unfold. However, the pandemic has also thwarted 2 of our investment themes, at least temporarily. Our US urbanization theme, you may recall, sought to exploit wealthy Americans' growing preference for living in dense, walkable cities and inner suburbs, just a short commute from the office. Areas with abundant restaurants and cultural institutions and lots of bike lanes were very attractive places to live. The pandemic-induced work-from-home environment obviated the benefits of short commutes and made most urban amenities unsafe or unavailable. Simultaneously, it made larger homes available in outer suburbs and rural areas more attractive. With many wealthy Americans relocating to their country homes or considering a move, we exited our investments in this theme earlier this year. We may revisit the theme when the pandemic approaches an end. Certainly, the pandemic-induced higher divorce rates and fewer babies will likely spur a resurgence in city living at some point. But in place of our US urbanization theme, we are adding a new theme, long-term beneficiaries of the crisis. Crises and recessions often reshuffle the decks. Leaders end up laggards, while companies with the resources and foresight to take forceful, decisive action leap to the head of the pack. Our initial investments in this theme include companies benefiting from both the breakneck pace of new business formations and the increased numbers of displaced workers. Companies able to improve their margins by eliminating middlemen between their customers and themselves comprise another group. We expect to continue to add investments in this theme as our research progresses. The COVID-related recession also upended our cyclical investment theme. We're replacing it with a new and quite controversial macroeconomic theme, which we're calling a temporary end to disinflation's tailwinds. After a decade of central banks trying and failing to raise inflation to their targets, many investors have concluded that secular disinflationary forces are just too hard to counter. We disagree. In the 1970s, inflation became so entrenched in the US that nobody believed that Fed Chairman Paul Volcker would succeed when he promised to bring inflation under control. But he did. Fast forward to August 2020, Fed Chairman Jerome Powell changed the Federal Reserve's policy objective to average inflation targeting rather than just inflation targeting. This allows the Fed to keep interest rates extremely low well after inflation exceeds its prior target of 2%. In essence, Powell was admitting that deflation, not inflation, was the Fed's dominant concern. We think Powell, like Volcker, will succeed. Importantly, Powell is getting some powerful assists in his effort to resuscitate inflation. The first assist is from fiscal spending. Despite the recent stalemate over passing another pandemic relief package, there is little doubt that the US and many other countries have abandoned fiscal austerity. Massive deficit spending is the order of the day. Historically, huge budget deficits have been inflationary in the medium and longer term. Inflation may also get an assist from energy prices, which we believe could rebound from current lows. Yes, oil demand has fallen precipitously during the pandemic. I go days without getting in my car, and US airlines are still operating well below 50% capacity. But the energy sector may be the only major industry that has been truly starved for capital in recent years. The collapse in energy investment has reduced oil production by over 2 million barrels a day this year. The number of rigs operating in the US has slumped from 2,000 in 2010 to just 269 today, a generational low. OPEC and Russian capacity has also declined significantly. With valuations at all-time lows, oil companies have no incentive to increase production. Thus, when people do return to driving and air traffic rebounds, increased demand for oil will confront low production capacity and likely will drive up prices. Eventually, higher prices will spur investment in production capacity, but it won't happen overnight. So a bit of humility is in order here. While accurately forecasting inflation is crucial because inflation affects forecasts for everything else, including interest rates, equity multiples, and real returns, it's very, very hard. We don't pretend we'll get inflation's future level or timing spot on, but we don't need inflation to skyrocket to 1970 levels to benefit from our investments in this new theme. With the market consensus firmly in the no inflation/deflation camp and valuations of inflation beneficiaries at rock bottom levels globally, even a mild uptick in inflation will likely generate significant portfolio gains. So I began my remarks by noting how difficult this year has been for almost everyone and almost everything except for financial markets. I'll end with noting that we don't know when the pandemic will end. We hope life may begin to normalize sometime next year. Counterintuitively, that may be when financial markets begin to dip due to high valuations and fears of an end to emergency fiscal and monetary stimulus. If inflation does begin to rear its head, which we think may be likely, interest rates are likely to rise, particularly for long-term bonds, and multiples for equities will likely compress, particularly for growth stocks. In these difficult times, as always, we will do our best to make sound investment decisions based on our deep thematic research and prudent consideration of both return and risk, with one key aim in mind, and that is to help you meet your financial objectives. Thank you for your trust in us. Now I'm going to turn the virtual microphone over to my very good friend and the best political analyst I know, Dan Clifton. Dan is a partner and head of policy research for Strategas Securities. In this capacity, he evaluates the financial market implications of policy and political developments. This includes analyzing trade, tax, healthcare, energy, and other policy initiatives to determine how public policy changes impact the economy and financial markets for investors. Dan leads 2019's #1 ranked Washington policy team on Wall Street, according to Institutional Investor magazine. He has been ranked a top Washington policy analyst in each of the past 11 years. Dan is also a top-ranked analyst in the category of tax and accounting policy. His research on the interaction between policy elections and financial markets is widely cited in the media, and he is a frequent guest on CNBC, Bloomberg, and Fox Business. Prior to joining Strategas, Dan was the executive director of the American Shareholders Association, the ASA, a nonpartisan nonprofit organization which analyzes public policy affecting shareholders. In this capacity, he was part of coalitions that successfully lowered capital gains and dividend tax rates to 15% in 2003 and a repatriation tax holiday on foreign source revenue in 2004. He also helped reform the nation's private sector pension system. Prior to joining ASA, Dan was the Federal Affairs Manager for Americans for Tax Reform and served as a senior staff member in 2 gubernatorial administrations working on economic and fiscal policy issues. He has also worked in various capacities on elections at a federal, state, and local levels. Dan received both his BA in urban planning and his MS in public policy from Rutgers University, where he was a fellow at the Eagleton Institute of Politics and a Harold Martin Fellow for Public Policy. As Stacy said, when Dan is finished with his remarks, we'll both take questions. Thank you again, and now I'll turn it over to Dan.
Well, thank you, Amy. It's great to be here. We're just 6 days away from an election. I couldn't think of a better time to be able to talk about U.S. political environment, the potential outcomes, and the implications of those outcomes. I do want to start off by saying that it is an honor to be here. And I work with a lot of institutional investors. They're very good at what they do. But Amy, you are the best thematic investor that I know. And it is such an honor to learn from you every single day. And thank you for having me.
Yeah.
Before we get to the fun part about Trump versus Biden and what's going to happen in the Senate races, I thought we'd start by taking a look at the U.S. political environment, the environment that we're in, and how this election fits within the overall change that's going on in the U.S. political system. And then we'll talk about the current election, and then obviously work through the policy implications and the economic and financial market impacts. I'll speak for about 15 minutes, and then I look forward to everybody's questions where we can dig deeper into any of these issues, ones that I spoke about and ones that I didn't. Let me start by saying that before COVID arrived here in the United States, economic volatility in America was creating political volatility. I would argue since the financial crisis in 2008, the U.S. economy has been growing at a rate that is much lower than we have historically. In fact, the U.S. economy had been growing at about 2% per year after inflation, down from a trend growth rate of 3% per year that really lasted 70 or 80 years. You say, well, what's the big deal? It's only a 1% change. Well, the big deal is if the U.S. economy had been growing at 3% per year for the last 12 years, the U.S. economy today would be $3.5 trillion larger, and the average American household would be $50,000 wealthier. In my view, voters know there's something inherently wrong, that their income and standard of living just has not been growing at the rate that they have been accustomed to. And if you're a younger worker who graduated college in 2006, you've never really seen the benefit of a 3% growth rate or the full income growth that Americans are used to. So how does this translate into the political environment? The U.S. has had 7 federal elections since the financial crisis, and the voters of this country have removed the party in power in 6 of those 7 elections. During this time, we've tried all Republican and all Democrat governments. We've tried to mix it up with split government, Democrat president, Republican Congress, and vice versa. In 2016, we took a roll of the dice and said, let's see if this Trump guy can make it any different. And none of these combinations have been able to get that growth rate higher. This was all before COVID happened. And when COVID hit here, it really transformed the U.S. political system by throwing gasoline on the fire of an already volatile situation. Today, we are facing 4 super transformational events at one time. We have a recession, we have a pandemic, we have mass protest, and we have an election. All of those are happening at one time. We've gone back 100 years to the modern political system, and we said, have we ever had 4 of these events happening in 1 year? And the answer is no. The most we can find are 3 of these 4 events happening, and that's happened in 3 different years. The last time was 1968. So you're talking about 52 years ago for even something close to what we're facing this year. And in my opinion, that increases the range of outcomes as we head into the election. That's different than just saying, oh, well, maybe Trump can win, or maybe Brexit can happen, or maybe Biden's going to win. We are talking about and studying issues of contested elections. How does the House of Representatives vote to make the next person president of the United States? Something that really hasn't happened since 1876. In my lifetime, these were near 0% probability events. Today, it's not the base case, but it's no longer the 0 probability event. And so in 2016, I was asked to speak to Chevy Chase clients, and I said, you know, this Trump guy may have a better chance than people are giving him credit for. This time around, we're arguing for post-election volatility that could arise if the election tightens up here in the last few days. Even if Biden is going to win, how does it work when we are counting votes 6-7 days later? As Amy noted, the pandemic's changed everything in our life. It's also changing the way we vote, the way we count those votes, and the way those votes will be reported. And it will be very different than anything that we have ever seen before. So given the unprecedented nature of this election, or this election happening in an age of disruption, I sat down with my team in late March, early April, and said, we need a framework to better understand this election and to be able to work through the election. And we really came up with 3 big themes, which I think are actually important for monitoring the election over the next 6 days. Theme 1 asked the most important question of this election. Is this a referendum on Donald Trump, or is this a choice between Donald Trump and Joe Biden? My experience in politics is that elected officials, all the way from the local school board to the president of the United States, they get reelected if they govern well and then convince voters that changing course midstream with their opponent would be a risky endeavor. Let me give you 2 examples. 2012, President Obama was running against Mitt Romney for re-election, and he argued that if we stopped midstream post-financial crisis, we would be introducing the policies that got us in the financial crisis in the first place. He effectively made the race a choice between himself and Mitt Romney and did it successfully. In 2004, George W. Bush was running against John Kerry. This followed the horrific attacks of 9/11 that happened on this country. And George Bush argued that if we change course midstream, we will risk the homeland and national security changes that he has made that is keeping us safer in a post-9/11 world. He effectively made the race a choice between him and John Kerry. You have not seen that this election. This has been a referendum on Donald Trump. It's very interesting because it wasn't really until the first vice presidential debate where people would say, oh, what about fracking? What about court packing? You never heard that because it's all been about the pandemic. It's consumed our life and it's consumed our politics. And as long as it was a referendum on the pandemic, Trump's numbers were going to be restrained. The first indicator I want to introduce to you that I love to watch that gets around some of the polling issues is the president's approval rating. We think the president's approval rating is a far better predictor of how the president does in a re-election than the polling numbers. The president polling numbers in most of the summer was below 40%, and he was hanging out with two other presidents, George Herbert Walker Bush and Jimmy Carter. As many of you know, those are the only two presidents to go on to lose re-election in a post-World War II, and not exactly the presidents that I would want to be hanging out with. What is interesting is that as COVID began to wane in late summer, and as the economy began to reopen, the president's numbers started slowly going higher. He was effectively starting to be able to get traction on other issues, talking about law and order, talking about taxes, and he was really starting to tighten the race up before the first debate and his COVID diagnosis. He was getting close to where Obama and George W. Bush were. But what you've seen since early October is the president is somewhere between the losers, where he's above the losers and below the winners. He's sort of in a no man's land. And I thought his numbers would actually start going higher over the last couple of days, and they've actually been somewhat restrained. And so we've never seen a president sitting out there in no man's land, and it's telling us that he's not making it a choice between him and Biden in the final weeks. So that's framework number one. Framework number two is what's happening on the economy and COVID. Nearly every election in the U.S. in the last 100 years has turned on the U.S. economy. How do we know this? Every president that avoided a recession 2 years before their reelection went on to win reelection. And every president that had a recession 2 years before their reelection went on to lose. So it's a really simple formula. You want to get reelected? Avoid a recession. I think Amy would agree with me that in January, it didn't look like there was a recession on the horizon. And that is obviously a benefit to the president. But COVID came and actually had a significant contraction in the economy. The 32% decline in the economy in the first quarter is nothing I thought I'd ever see in my lifetime. What's interesting to us, if you go back into Amy's presentation, is that a lot of the factors of traditional recessions have not played out in this recession. Credit is abundant. Half of the jobs have been replaced. The economy has been less of a liability for the president than we would assume in this election. In fact, I would argue it's actually become an asset over the last maybe last month or so. Tomorrow, we're going to get third quarter gross domestic product at 8:30 in the morning, and it should show that the U.S. economy grew somewhere in the range of 35% in the third quarter. It allows the president to say, we had this major event happen, and I have now started to right the ship. We're close on therapeutics, we're close on a vaccine, and the economy is rebounded. Now, it takes discipline. I don't know if the president has the discipline to say that, but that is a positive event. And I think that it's been reflected in some of the president's numbers improving. But there are two elections that did not turn on the economy in recent times. They are 1968 and they are 1976. We build an economic model to get around the polls to predict elections. And it is very, very highly predictive. It predicts within 0.2% of what the incumbent party should get based on the economy. The four variables that we use are the S&P 500, the dollar, gross domestic product, and the president's approval rating. Those indicators are telling us that not only would the president win the electoral college, but he would win the popular vote. Now, none of us believe the president's going to win the popular vote. And that tells you that this election is about something else. And it's about COVID-19 and a referendum on COVID-19. The single best chart I have ever produced in 13 years at Strategas is a chart of the number of percentage of swing state voters worried about COVID and Joe Biden's lead in the swing states. It is literally the same exact line. As the number of voters worry about COVID, Biden's lead goes up in the swing state. As they decline in their worry about it, Biden's lead shrinks. And so this economy is important. I think it's helped Trump stay in there, but you have COVID-19. And why that's important, you are seeing an October surprise developing in the Midwest where COVID-19 is starting to increase in Wisconsin and Montana and Iowa. We're seeing broad improvement in the president's numbers in Florida, North Carolina, starting to see it in Pennsylvania. None of that matters if he doesn't turn those Midwest states as well, and they're not moving the same way the southern states are moving here in the close of the election. And so that leads us to our third framework of what is happening in the swing states. There are 6 that I would keep an eye on: Florida, North Carolina, Arizona, Wisconsin, Pennsylvania, and Michigan. All the other states should move accordingly if these states move in one direction or another. And what we see is that the president is surgically going into Florida before the voting started, laying down his advertising, running his ground war, and then his numbers are improving. And then he's going into North Carolina and doing that. Now he's slowly moving into Pennsylvania. And so what you see is the president's numbers are coming down in Montana. The president's numbers are coming down in Texas. And they're almost saying like, well, we'll still win them, but we'll win them by 3 or 4 points. But we got to focus on these states. It's triage to stay in the race. And I would just argue with a bit of caution that the president's move over the last week or two has actually been pretty significant in the swing states. I wrote a note about this today, and I got so much hate mail from clients like, no, they're not really narrowing. They're narrowing. It may be too little, too late, but they're narrowing. And so what I would say is that taking all that together, Joe Biden is the favorite to win. He's got a 65% probability to win. I know some of the poll-based forecasters are at 80, 85%. And I would only change that view if I see 3 things. 1, I see Pennsylvania turn to Trump. 2, I see the president's approval rating go up. And 3, I see the congressional generic ballot start to go down. That asks voters, who do you want to run Congress, Republican or Democrats? That crashed in the final week of the 2016 race, which was a sign to us that Trump was in a better position than the consensus believed. And it's just not moving the same way it did in 2016. We're just getting the polls back from Thursday's debate. And I think the impact of Thursday's debate is, for the first time, Trump voters are saying, that's our guy. They couldn't do that the first week of October after the bad first debate and the COVID diagnosis. And so where does that leave us? What is interesting to us, the big change in this election has not really been at the presidential race. It's been on the Senate side. The market has been anticipating a blue wave for the last 2.5 months. That means a Democratic president, Democratic House, and Democratic White House, Senate. And what's happened is that these races are starting to close up as the president's numbers have begun to improve. And so I think the Democrats are going to win Colorado. I think they're going to win Arizona, and I think they're going to win Maine. But North Carolina and Iowa, which were really kind of going in the Democrats' direction, have started to kind of go back the other direction. And the Democrats need to win all 5 of those to win the United States Senate. And so you've seen the odds of a Democratic sweep in the betting markets fall from about 65% 2 weeks ago to about 50% today. And that is starting to impact financial markets, because in a blue wave scenario, it's easier to get that stimulus that Amy was referring to, and it's easier to get a larger package in the range of 2.5 trillion and the inflation call. By the way, we're going to get it no matter what. It's just the size and timing and process by which we get it is going to be different. 1/4 of that is COVID money, and we have COVID increasing across the country. So my sense is that at some point after the election, the politics will go away, cooler heads will prevail, and it really doesn't matter who wins the election. in terms of getting something done on the stimulus. So let me just give you some quick policy implications, and then I'll turn it over to questions. But the blue wave scenario still remains the consensus amongst my clients. And I think it's very interesting. The area that I believe is the most starkest between Biden and Trump is on international trade. We believe that Biden will pursue a more conciliatory international relations program by getting rid of tariffs and by looking at new tactics on China. By the way, I think Biden will be very tough on China, but it will be tough in a different way, not economic warfare, but more diplomatic warfare and using allies to go after them. And so the biggest impact that I'm seeing from this election is on the value of the US dollar, where the market views Biden as a weak dollar president. And I don't say that in a negative term. As Trump engaged in his trade war, you saw the dollar go up because it hurt other countries more than it hurt the US. And what the market is saying is that Biden is probably going to reverse a lot of those America First trade policies. Since 2018, January of 2018, US stocks have outperformed non-US stocks by 50%. That's the America First trade. And the market is starting to price that trade coming out. How do we know that? We can literally take the Chinese stock market and the Vietnam stock market and run the two relative to each other. As Biden's probability goes up, China outperforms Vietnam. As Trump's odds go up, Vietnam outperforms China. That is the way the market is reading the decoupling trade. If Trump wins, decoupling happens faster than if Biden wins. It is incredible to watch currencies and entire country stock markets trading on the US election. It actually shows you how important the US is, despite a lot of people saying that the US is losing its importance. And so you get that regardless of whether the Democrats win the Senate or not. You get easing financial conditions, a lower dollar, and I think that's good for US companies that have large foreign revenue exposure, industrials, materials. On top of that, fiscal policy will be a big priority for the Democrats. Crushing the virus, as Speaker Pelosi likes to say. Lots of money for healthcare. I heard Amy use the word Illumina. Lots of money for life science tools and research on pandemics. It's a great area to be in, regardless of what happens on the ACA debate with the Democrats. Additionally, more money for climate change, more money for infrastructure, more money for healthcare and education. Those are going to be the big priorities in a stimulus package, as well as more money for state governments, which probably are the biggest winners in a Democratic sweep, given that you'll get a reinstatement of the state and local tax deduction, more money for state budgets, more money for Medicaid. And when we raise taxes, you see investors put money in tax exempt areas like municipal bonds. So it's sort of like a grand slam for the state governments if the Democrats win. We obviously have to deal with the tax increases. And what the Biden folks have done is that they've come to Wall Street and said, we're going to do $2 trillion, $3 trillion of fiscal spending, and we're going to do a couple $100 billion of tax increase. Net, from a macroeconomic perspective, net accretive for fiscal policy. Now, if you're the taxpayer who's got to pay that higher tax, there's going to be implications to that, especially when you start talking about doubling the capital gains rate, doubling the dividend tax rate. Those are going to have important behavioral effects when that happens. Last point I'll make on that is that the Biden campaign is talking about delaying the corporate tax rate to 2022. That's important because that gets you about 10% more earnings per share in the S&P 500 in 2021. And they're talking about a phase-in of that tax increase over time. So I do anticipate those tax issues are going to get a lot more attention. If the Republicans somehow keep the Senate while Biden wins the presidency, which is enormously rare, it's happened 2 times in the last 60, 70 years. Usually a new president starts with a Senate of his own party. But if that happens, the market's not going to like that initially because they want that stimulus. But I don't think it's a bad combination. You still get the benefits of international trade and you don't get any of the tax increases. And at some point you will get maybe a $1.5 or $1.8 trillion stimulus. These are still enormous numbers. The president's tax cut was $700 billion over 10 years, and it was enormous. This is like $1.5 trillion in 18 months. And so I don't think any of these scenarios are bad, particularly if we're still making progress on a vaccine and you start to see the light at the end of the tunnel on this crazy pandemic that has changed our lives. If the president wins, you're thinking about a person who had the Mueller investigation, had impeachment, had a recession, had a pandemic, caught COVID himself, and still won. You can only imagine how intense he's going to be if he wins. He's going to believe that he can do anything he wants. And the first thing he's going to do is start arm twisting Mitch McConnell to stop holding up all of that infrastructure money he wants to do. I also think that you're going to see Trump try and inject more tax cuts into whatever bill he will do with Nancy Pelosi on fiscal policy stimulus. But the right way to think about a second-term Trump administration is on international relations and the continued movement and decoupling from China. For better or worse, economically, the U.S. government continues to see China as a national security threat, even more so than the economics of it, and Trump will carry that out. And I think he's become very emboldened on that. So I'll stop there. We didn't get to talk about all the fun stuff like contested elections or, get deeper into these issues. But Amy, I thought that might be a good way to just start the conversation, and then we can dig deeper into questions that anybody has. Thank you again for having me today.
That was great, Dan. Thank you. I love listening to you. We do have a lot of questions, so I'll just start with one that I'm actually curious about. What does the early voting change? What is the levels of early voting signify? Does that change things? Does that change how you're looking at the last 6 days?
First, let me say, America should be celebrating. I know it's hard to celebrate in light of the tough year that we had. But we had 135 million people vote in 2016, which was a really high number. We will get close to 160 million this election cycle. And so regardless of whatever the outcome is, more Americans are voting, and we are getting closer to full American votes. That is a great, great accomplishment. The early voting shows high levels of enthusiasm for people to go out and vote. I've been very worried about election administration because my experience is that poll worker volunteers generally are older Americans who are more susceptible to coronavirus. And I said, how are we going to do this? People are going to have to wait in line for hours. They're waiting in line for hours. And while some people complain about it, people are just happy to vote. More mail-in voting. It's made it easier to do. And so that's why I think we'll have record turnout. Both sides are energized. We've been trying to figure out, is one side energized or not? When I worked on a presidential campaign, I had access to those numbers. I ran those numbers. We had the targets. It is almost impossible for me to gauge what early voting means for the election in terms of who's going to win. I'll give you this example. In Texas, the 5 top counties for early voting are counties that went 20% or more for Donald Trump. The 5 worst counties, 4 out of 5 of them went 20% or more for Hillary Clinton. So if you look at that, you're like, oh, the Trump people are coming out and the Hillary people aren't going out. And then you look a little deeper and you're like, well, that's a suburban Dallas. That's your urbanization theme. People moving, right? The suburb of Austin. Here's your urbanization theme. People moving in. There's no way Trump's winning those counties by 20% this time. And what I think the campaigns are doing is they're going to their hardest place to get their voters out and going to them first. Where does it require the most level of work? So the Republicans have extraordinarily high turnout in Miami-Dade County. And the Republicans are going to lose Miami-Dade County by like 200,000 votes. That's what the sign is to me, is that when you get the people who normally don't vote out, we're headed for records. And as each day goes on, you start going closer and closer to your core voters. Those are people who vote 4 out of 4 elections because it just takes one contact with them. What's interesting to us is that Biden is running an air war. He's got $450 million. He is running advertising. and he is trying to bring people in and get them excited about voting. Trump is running a ground war because he wasted $1 billion, where he's out of money. And so the only way they can do it is go door knocking. They'll go knocking on 3 million doors this week. It's just amazing numbers. And so both parties have different strategies, and it's leading to this record turnout. And boy, it's going to be an exciting political science experiment when this is over. Counties we're watching is a county like Sumter County. In Florida, there's a place called The Villages. There's like 100,000 senior citizens there. We are watching that turnout, because if you see that the seniors are going to not vote as strong there for Trump as they did in 2016, it tells you that the COVID-19 election is in effect and the seniors are revolting against Trump. And you know what we found, Amy? We found that we know how many Democrats, we know how many Republicans, we know how many independents, but we don't know what the independents are actually voting, and they are going to be the swing. And so you won't see a lot of analysis in our reports about what the early voting signifies, other than it's a great thing for America.
Do you think we'll know the winner on November 3rd?
So this is one of the most important ideas that I can tell you tonight. Florida, North Carolina, and Ohio have really great laws in place. They have early voting. They have experience with mail-in voting. And like North Carolina is telling us that when they release the results, or when the polls close, we should have 80% of the mail-in vote right at 8 o'clock at night. Now, I don't know if that's true or not. Maybe there's hiccups. But we are going to know we are going to know the results of Florida, North Carolina, and Ohio. It could turn out that they're so close we don't know who won them. But if Trump loses Florida, the race is over. I may actually have dinner with my family on election night, something I've never done, if Trump loses Florida. I'm kidding when I say that. But the point being is that Florida is such an important indicator, because there's no path to 270 electoral votes for Trump without Florida. And so if, he loses 2-3%, he can't even pretend like, hey, I'm president, remove me from office. It's like a clear loss for him. But if Trump wins Florida, North Carolina, and Ohio, which we can know by 11, 12 o'clock at night, he punches his ticket up into the Midwest.
Right.
Okay? And this is why I'm writing how important the race tightening. I don't care what's happening across the country. I don't care what's happening in national polls. I just care what's happening in these states. Because if Trump wins these states, punches his ticket, goes up to the Midwest, they have completely different laws in Pennsylvania, Michigan, and Wisconsin, and they have less experience with this mail-in voting. The most important change is that they don't start opening to authorize the mail-in ballots until after the polls close. So North Carolina is going to tell us what the mail-in vote count is and who won, and Pennsylvania will just start opening up those ballots and authorizing them. It's going to take 6 to 10 days to count these. Pennsylvania just got a court ruling where ballots can come in 3-4 days after the election. Right. And so that means you are facing a situation where Trump is tweeting from the White House on Wednesday morning that the election is being stolen from him. Okay? Because he's going to have a huge number on the vote machines, because that's the way Republicans are voting. And Democrats are voting by mail, and that lead is going to slowly start to dissipate. This is what happened in Arizona in 2018 Senate race. The Republican won on election night, and over 6 days, she lost her election. That was a very cordial event. There's nothing cordial about Donald Trump. Let me take you over to the other side, though, because the Democrats are going to have their issue. Democrat pollsters are subtracting 1 or 2% off of Biden's numbers when they poll these states, because the error rate for these mail-in ballots are so high. Okay? So what happens is, Wisconsin, good example, Trump won by 22,000 votes. Wisconsin threw 23,000 absentee ballots out in the primary. That means there's going to be far more in the general election. So Trump could win one of these states by an amount smaller than the number of ballots that get thrown out. And the Democrats are going to go to court and try and get all those ballots reinstated.
Aye.
Okay, I don't mean to make your head spin. I don't mean to scare anybody. But this is what we are preparing for if Trump wins those first 3 states that I mentioned, Ohio, Florida, and North Carolina. And By the way, this can all end if he loses Arizona later on in the night. But that's kind of our official viewer's guide to how to interpret the results as they come in on election night.
Okay, thank you. We have a lot of questions about capital gains taxes.
Yep.
And what would that mean? There's also been a lot of analysis about how when Trump was elected, we thought it was financials and energy that were going to be the big winners. They were the big winners for a few months, and then the next 3 years, they were the losers. How do you think about sectors and specific actions that people are talking about, specifically the capital gains tax?
Yeah, let me take those separately. The capital gains tax is interesting to me because it directly affects the after-tax rate of return for investors. So if you are at a 20% capital gains rate and it goes to 40, the hurdle rate for your investment goes up pretty significantly. And so what we're seeing from our venture capital and our private equity clients is that their companies that they have are all trying to have an event so that they can sell before the tax rate goes up. Really amazing to see. And you're starting to see a merger and acquisition boom happening because of pent-up demand of COVID, plus the taxes, plus the antitrust review. So it does affect behavior. We have cut the capital gains tax 4 times, and we have raised the capital gains tax 4 times since 1968. And you get a short-term sell-off after those tax increases. It's short-term. 3 out of 4 times. The only exception is 2013, which I'm going to come back to in a minute. One of the great years for stocks. And when we cut it 4 times, 3 of those times you had a higher stock market. And it's basically linear. The more you raise it, the bigger the stock market becomes. But financial markets are complex. There's something called all else being equal. All else being equal, it should hurt returns. In 2013, we raised the capital gains tax from 15 to 23%. And the U.S. equity market went up 32%. The companies most impacted by that are growth companies, and they were up 40, 50% that year, if you remember that year.
Yeah.
Because the Fed and global central banks were pumping so much liquidity into the system, it just overwhelmed the capital gains tax increase. So you're going to have a higher tax burden. It is going to suppress capital gains realizations. But my sense is that there's enough liquidity going on that it won't be as negative as it would be in an all else being equal scenario on the capital gains. I would just make this one point, though. Dividends are going to be important. When Obama won in 2012, we had something called the fiscal cliff that was going to have massive tax increases and spending cuts on January 1st. 1,100 companies paid a special dividend in the final 6 weeks of the year before the January 1st. And when I say companies, I'm talking America's largest companies pulled forward that dividend income in. So people are like, oh, my taxes are going up. Should I sell? And I'm like, no, because there's going to be a wave of dividend money coming in. Okay. And what I see happening on the wealth advisory side, and I don't want to conflict with anything you're telling your clients, Amy, but what I see happening on the wealth advisory side are people are saying, listen, if you were in a stock and it's up big over 5 years, you might want to take some of those gains now, but reinvest it back in to something else that's going to do better. You mentioned finance.
Exactly what we're telling our clients, yes.
I think that's sound advice.
Mm-hmm.
And so you mentioned financials and energy, which I think is very connected to this conversation. I build portfolios for the election. Trump portfolio, Biden portfolio, Trump portfolio, Clinton portfolio, Obama, Romney, Obama, McCain. They are awesome diagnostic tools of how the market thinks about the election ahead of the election. Our Trump portfolio crushed our Hillary portfolio in the final 3 months of 2016, a sign that the market saw the election better than the polls and the pundits. What was in that Trump portfolio was financials and energy and all the issues that you just referred. And what I have learned is you get a very good first year, maybe 15 months after the election in those portfolios. Our Obama portfolio in 2013 did great after he won re-election. And it went on for like 15 months. And the same thing happened with Trump. You got tax reform. It kind of put the seal on the whole thing. The defense stocks were up because they got their defense money. And then he engaged in a trade war. And when he went into the trade war, he literally started flattening the yield curve. And when you start flattening the yield curve, whoa, it's not good. Okay. And guess who gets hurt by that? Financials, energy. And so I'm not a big believer in the idea that just because it didn't work for the final 3 years of the Trump administration, it's not a good way to think about post-election. But what I wrote about today is that I'm starting to like financials and energy here, despite the possibility of a Democratic sweep. The reason for that is that all the regulatory stuff that the Democrats will do to these industries have priced into the stocks because the market is fairly confident that Biden is going to win the presidency. And we're going to do large fiscal stimulus and the dollar's weakening, which is good for oil prices. And all the stuff that you just talked about fracking, let me throw one more in there for you. And that is the massive consolidation that's happening in the oil and gas space right now that is actually going to get some of the cost out of the system.
Yep.
So Democrat sweep, you could see a rise in some of these companies. But if the Republicans surprise and win here, then all of the bad stuff that's priced in comes out.
Yeah.
You do have a little bit of a hiccup here where yields are probably going to go down. That's going to hurt financials and people are going to be worried about fiscal stimulus. I think that's temporary. You know, and I don't mean to kind of plug this kind of sector basis around that, but I do think that the sector thesis holds for these elections: renewable energy, infrastructure, healthcare, and technology, which are my big winners under a Democratic sweep, based on what the policies are that are going to be impacted. But I can't guarantee you that at the end of the next administration's term that they're going to be the big outperformers. Because I can take the big performers of the Obama years and the big performers of the Trump years, and you know what it is? It's like tech and consumer.
It's the same thing.
Same thing.
Right.
It's the same thing. And oil stocks were bad in the last 4 years of Obama and for the first 4 years of Trump.
Right. Yeah. It just shows you how much influence or lack of influence it really does have when other things are, as you said, all else is not equal.
That's right. But I would just say, though, you've got to identify the transformational events while they're happening. Right. Obamacare was a transformational event for the healthcare sector. And once we started putting money into the healthcare sector in 2013, you just saw everything take off there. And so sometimes there are things that are so large that it creates a secular change. But most of the stuff on this policy is, a short-term, 1 year earnings benefit that might not have been priced in. And I would argue that this will be the first climate change election in America if the Democrats sweep. And that's what renewable energy stocks are reflecting.
Yeah. And do you think, there's a question here about Trump's character, and debasement of minorities is in the question. And
yep.
Do you think this is a non-economic election, as you sort of referred to, that we haven't had since
Great question. Yeah.
World War II?
Yep.
And does 2018 inform that at all?
Yeah. So both of them are great questions. You'll hear me talk a lot about 1968. This is almost like 1968 in reverse. Mm-hmm. Democrats were in control in 1968, and there was a lot of protests, the Democratic Convention. I'm sure you remember everything that happened in 1968. Law and order was a very big theme in 1968, which allowed the Republicans to win the White House, even though the economy was relatively strong. Vietnam War was another issue. It's one of the few non-economic elections that we've seen. It's different because it was an open election. Lyndon Johnson had stepped down. The economy was really, really strong in that 1968 election. And the Democrats really wouldn't have lost it if it was an election on the economy. And so what happened was, when we started to see some social protesting, social unrest after the unfortunate death of George Floyd, people said, oh, this is going to help Trump. It's like 1968 all over again. And I would actually argue it was in reverse. Right. People were like, I don't want the nonsense anymore.
Right.
And so what happened was our Republican portfolio started to increase because when the protests started, it was like, oh, the restrictions on COVID are over. We're going to have a reopening here.
Mm-hmm. Right.
And what happened was the betting market said, no, this is going to kill Trump's presidency because it will be a non-economic presidency. He is not up for the job. That's the way the betting odds read it. And the betting odds turned out to be right from that view. So when I take all that together, it's definitely a non-economic election. COVID-19 and everything about COVID-19 that came from that is driving this. But 2018 is interesting to us because I never extrapolate midterm election results to presidential election. If that was the case, Republicans would have won in 2012, or Republicans would have won in 1996, or Democrats would have won in 1984. Usually what you get is a snapback where, oh, Trump won, everything's back to normal for Republican voters. They go back to their lives. And Democrats are like, this guy's a disaster. And then they mobilize. And then everybody comes back together 4 years later and we have a fight and it's a close election and usually the incumbent wins. Mm-hmm. What you are seeing is a dramatic reorganization of U.S. politics because you are now moving these high-income suburbs, which traditionally voted Republican, are now voting Democrat. We don't want our kids to learn this guy's values. Mm-hmm. That is a game changer, what is happening around the country. And so I just think politics are realigning, and there really is no place for populism during a pandemic.
Right. So you think midterm elections aren't economically based, but
yep,
presidential elections are.
Yep. We have
this one could be a non-economic election.
Correct. Yep.
Okay. And what about tariff policy under the two regimes, and what does that do for the economy, or how does that impact the economy and potentially the markets, if you want to go there?
So again, think about how important presidents are. Mm-hmm. 4 years ago, on October 28th, very few people were talking about trade policy, other than Trump may get us out of NAFTA on day one. Trump has focused the entire world on China. And it's not just us, it's our allies. Obama had a different relationship with China where he needed a partner on climate change. If China is going to reduce emissions, then the whole world will sign up for the Paris Climate Change Agreement. So he sort of didn't focus on some of the issues that Trump was focused on. And Biden, I got to tell you, is tougher on China than Obama will be. And again, I see the institution of government, regardless of who's running president, starting to view China as an enemy. Trump thought that he can do this by tariffs, hurt them economically. And tariffs were the first step. We're now in step 2, which is a capital war on China, where he's pressuring pension funds not to invest in China's securities, where Huawei will not be able to have its product, or WhatsApp, which is, things that are used in China for marketing by U.S. companies. And what Trump's trying to do is trying to make it so costly for American companies to do business there that they have to move their supply chains out. Biden is like, no, it's not working. So I want to go and use our allies to put multilateral pressure on China and force them to start making changes so that there is a more level playing field. In a way, if it works, this is not politically correct. What I'm going to say is the 1-2 punch of Trump-Biden is actually kind of interesting. Trump came in and punched the bully in the mouth, and Biden comes in and says, that guy, he was crazy. Let's work together, but you got to put some stuff on the table. I'm not going to be able to hold Chuck Schumer and Nancy Pelosi back, who are very anti-China. So that's the way I think it's good. I think we're over the tariff policy. And I think we're more in a diplomatic pressure, and Biden knows where those levers are. So we'll see if it works. But the tariff policy hurt everybody. There's no winners in that. And I'm sympathetic to the argument that the U.S. sees this as an emerging Cold War and that it's existential. But I'm not really sure tariffs were the way to solve that.
Right. So there are a bunch of questions which I think are interesting of sort of what happens if Trump wins again.
Yep.
one question specifically focused on protests, but just generally, I mean, I could, what do you think?
As you know, Amy, we're preparing for all scenarios.
Right.
And my probability of Trump winning is much higher than the consensus right now.
Right.
I just think that there's something out there that the polls don't really represent or understand, and my friends here in Washington don't truly get. And like Minnesota looks very much better for Trump than the polls do when you're on the ground in Minnesota, right? So he could win. Elections are about the future. Everything you hear from Trump is, this is what I did, this is what I did. Voters don't care. They want to know where you're going. If Savannah Guntry asked me a question about anything at a town hall, I'd say, Savannah, nobody's here for that. They want to know what I'm doing to make the economy better in light of COVID and what I am doing to keep families safe. And what am I doing on a vaccine? It is a truly innovation of America and global medical to get this close to a vaccine this quickly. As you know, it just doesn't happen.
Doesn't happen.
Doesn't happen. It may not be real.
It might not be, sadly.
It might not be real. But the companies are confident, and they are saying that this could be close to 50% effectiveness. I don't know. I'm not an expert on vaccines, but Trump will continue on that policy of pushing for better therapeutics, bringing them to market and the vaccine. It's really something that he doesn't get a lot of credit for, but he's been very forceful on that. And it's actually distracted from the actual response to COVID. But I think that's where it's going to go. And why I bring that up first is that no matter what you are doing, no matter what party you are, you wake up every day to crush the virus. That's what we want. And it may not seem empathetic at times, but that's what everybody's doing. Number two is that Trump is very focused on building things. Our whole view on infrastructure is never about who's president. It's about who's in Congress. And so Trump wanted everybody to buy infrastructure. And we were like, get out, because we never thought Mitch McConnell would ever give him the money. And we turned out to be right. Mitch McConnell never gave him the money. He will be pushing big for an infrastructure bill. And he will force Mitch McConnell to do it. And by the way, the Senate map for the Republicans is the worst map I've ever seen. So I'm going to have all these vulnerable Republicans looking for some level of accomplishment because they're going to be up for re-election. And that's what I would focus on. Now, I think you get a bigger infrastructure deal from the Democrats, but under either scenario, you're probably going to get it. Trump has a tax plan that was created pre-COVID. It is a 2-income tax rate structure, 15%, 28% with a huge standard deduction, $50,000 or something, and a 15% capital gains and dividend tax rate. Very focused on the individual side of the code because 2017 was all really about corporate and the individual stuff was sloppy. He's going to push it. And he's going to tell Pelosi, if you want something done, you got to put my tax plan in there. That's why the market's going to love that. Because there's a lot of stimulus in there. And if we don't care about deficits anymore, it doesn't matter how we get them. And then it's international relations. The Abraham Accords is really something that Trump wants to continue to push. He wants to get Saudi Arabia in that place where they're comfortable doing that at the end of the day, normalizing economic and diplomatic relations with Israel. And some of that's been going on for a decade anyway, behind the scenes. But he's really trying to shape the Middle East in his view. He's really trying to shape the supply chains of China. And I'll just give you one example. He's got a good relationship with Modi in India. And he's basically saying, Modi, you could be the guy to take all of those China supply chains because Vietnam just can't handle it all. Those are the areas where I think Trump is going to focus. Now, he's going to get a Supreme Court ruling on health care the last week of June of 2021. And so that's going to put health care on the table. No matter who's president, we're going to get that health care catalyst. And I think that the appointment of Amy Coney Barrett has actually been very good for the ACA debate because Democrats said, oh, she's going to kill the ACA. And it's been clear that the Senate Republicans are like, we're not going to kill the ACA. Right? So in a weird way, it kind of helped that situation. So those are areas where he is going to have to focus I wouldn't be surprised if he goes for a moderate immigration deal that creates a pathway to citizenship. If it was to be contrarian and controversial tonight, I think he would go for an immigration deal that would be very different than if he was running for re-election, which was very anti-immigrant. I think he would go for one that starts to create a pathway to citizenship and start to bring 11 million people out of the shadows and into the economy. That is a massive supply side labor market change, one that I think is very likely under a Democratic sweep, but one that could also happen under Trump.
And what about, there's a lot of questions about the political unrest. What about all the people who will be besides themselves with another 4 years?
Oh, so, Amy, I just, again, I watch people who said he had no chance 4 years ago come out publicly and say he's got no chance again. And by the way, I don't think two elections are ever the same. I think he needs a royal flush today. 4 years ago, he needed an inside straight. So the challenge is harder. But people have started to say he's got no chance. And that scares me because if he does win, the crash is going to be very hard.
Right.
If he wins, he is going to have won by losing the popular vote by 4 to 5% and still won the Electoral College.
Right.
Right?
What does that do to our country? What does that mean for our country?
That's going to rip our country apart. Now, George Bush and Al Gore had a close race, but George Bush then won re-election and won it by a couple percent with a majority of the vote.
Mm-hmm.
This would be 2 in a row. And it would actually be a higher deficit than before. So that poses some real challenge. And there was some press over the summertime about John Podesta, who was Hillary Clinton's campaign chairman, saying, they started role playing, and it was Trump legitimately won the Electoral College, and he refused, as playing Joe Biden, to concede unless there were concessions to deliver the electors on December 14th to elect the president, right? And so a lot of people look at it and say, oh, Trump won't leave office. There's some risk there. Everybody's keeping their options open. But I read this, and I was like, whoa, wait a minute here. Because the Electoral College is the law of the land. Mm-hmm. But popular vote has a very important significance to that. And so there could be real issues there. And, we have election night at our Washington, D.C. office. We're 2 blocks from the White House. My favorite night in a 4-year cycle. And we won't be anywhere near Washington, D.C. on election night, which is usually a jubilous night. But there's just some risk there on both ends.
Right. Yeah. We're in Washington, D.C. A lot of our clients are in Washington, D.C. I know people are getting out, but it's a little scary.
Yep.
What are the chances of real, if the Democrats do sweep, what are the chances of changes to the Electoral College? I mean, as
awesome.
The Electoral College gets sort of less representative of the country, and you can go into court packing if you think.
Yeah. It's all on the table, right? So, but by the way, this was all on the table before the Amy Coney Barrett nomination came up. I think President Obama gave a speech at Representative Lewis's funeral in July and said, listen, we got to get rid of the filibuster. It's a relic of civil rights times. The filibuster had never been framed in those types of terms before. And it's a lot harder to defend the filibuster in those terms than if you're like, well, we need consensus and cooler heads prevail from the Senate than the House, as it's always been argued. Mm-hmm. And so none of that, whatever you asked about court packing and statehood and all that, none of that is possible under a 60 vote rule in the Senate. And if that 60 vote rule goes away and it becomes a 51 vote rule, then the possibility begins to change. So what are the big asks? The big asks are DC statehood, Puerto Rico statehood. Those are ways to affect the electoral votes without changing the Electoral College.
Right.
Okay. But this is really interesting. There's actually a bipartisan group that is organizing in the states, state by state, to have state legislators pass for the constitutional change of the Electoral College. It's really worth it to take a look at. The guy running it came to my office to let me know about it. which means they're on a public education campaign. I didn't know the guy or anything. So, my point is they're making progress on that change. I think Virginia just signed up for it, and they have a lot of states that are already signed up. And that's the best way to change the Electoral College is through the constitutional amendment process, which is a very long and arduous process. Puerto Rico is in bankruptcy. No state can be in bankruptcy. So we'd have to figure some way around that. But on my way to work today, I heard a radio advertisement for DC statehood, which means there's money being spent on the DC statehood question. And, that's one way of doing it. On court packing, we got a real window into Joe Biden on the court packing issue because he was saying, I'm not going to tell you my opinion. On 60 Minutes on Sunday, he said, I'm going to create a commission, and that commission will report back to me in 6 months. Awesome. It's called pencil governing. You create a commission, and then in 6 months, whichever the way the wind's blowing, you can go and fill it in with the pencil. What I see Biden looking at is the threat of a change to the Supreme Court as a way to bring in Republicans to force change. I think he's doing that on the filibuster as well, saying, listen, we could go nuclear here or we could work together.
Right.
And I don't think Biden's really into the court packing because you really need to put 4 seats there. We haven't done that since like the 1860s. I think what he's doing is trying to set up reforms on lifetime appointments and rotating justices. And there's a series of menus of reforms that they can go down. But I don't know what the political environment's going to look like in 6 months. And whichever way that's going, they can make those changes. I think he's thinking that some of the pressure will be off in 6 months, particularly if they're governing and they're focused on tax and stimulus and COVID and healthcare and education and climate change, that some of that will start to fall by the wayside.
Okay, and I just received a question about, regardless of what happens with the ACA, what do you see for the potential for drug pricing under either administration?
These are great questions, amazing questions. So I got a healthcare report coming out tomorrow.
Okay.
And I break out healthcare into 3 broad categories. 1, COVID relief. 2, ACA. And 3, drug pricing. Every single healthcare industry has taken a haircut since the ACA passed, except 1, and that's the drug lobby.
Right.
They are very good. They are so good at what they do every day. And they are so good that President Obama does landmark healthcare legislation, and they get more Medicare spending on drugs. They get 12 years of data exclusivity for biologics. They are good. But you can feel the clock running down on them a little bit. And if you look at the Pelosi bill in the House, which passed this year and will pass again next year, it really decimates the industry. It really goes after their pricing structure in a very meaningful way that would be hard to get a return on investment capital moving forward. I do not believe that that's going to be the law of the land, but we got to go through that process. Biden is looking at the German model right now. The German model says you can price your drug the first year at whatever price you want, and then a committee will meet and do the comparative effectiveness and try and create what the economic value of that drug is. And it's arbitrated between the users, the providers, the managed care, the hospitals, and the drug companies. And then if there's no decision, it goes on. By the way, it's totally not optimal. But if pharma walks out of a Democratic majority with that,
right,
that's a huge win.
Exactly.
And the most important change is that you get rid of the uncertainty that has been hovering over this industry for years.
Right.
Okay. And if the Republicans keep the Senate, then you're looking at what's called the Wyden and Grassley bill, which to me is a one-time hit to their EBITDA, and the uncertainty goes away. What I'm arguing is I don't think the worst case scenario is going to happen. I actually think they're going to be pretty good. But like managed care companies during Obamacare, you had to go through a 9-month process that contracted on multiples. And until you got clarity, it was really hard to invest in those companies. Those companies were trading at 6 times earnings. They were trading almost as if they went out of business. And then the moderate Democrats got up and said, we're not going to do a public option. And they went on a 10-year bull run. And that's sort of a similar way that we've been thinking about biotech and pharma. And I say that in the context of their fundamentals are amazing right now. They really haven't done anything for 5 years, and they're truly innovating in so many different ways. And I'm so optimistic that if there's some silver lining out of COVID, is that some of the technologies might be applicable to the areas that you care about, like gene therapy and cancer. Oh, be great.
Well, I think some of the animosity towards the drug companies, when you see them step up and try to solve this crisis, dissipates a little bit.
Totally. Yep, totally.
I'll end on hopefully a positive note here. Well, I guess it depends on what side of the aisle you sit at, but Larry Summers was recently speaking at a conference that I attended, and he sort of just was saying there's a 50% chance at some point next year, and presuming he means if the Democrats win, that we enter into like an era of good feeling where people are, coming together more and happier, and that somehow, some way we put this period where honestly there are some questions about civil war in the queue.
Yep.
But could we? And this one question: could we herald a new center-left, center-right governing coalition under sort of a moderate president like Biden, presumably, and that sort of bring down the temperature and the political polarization? What are the chances for something like that happening?
I've been impressed with Biden because he will say, I won the primary. You keep trying to bring in all this progressive, but I won. Bernie Sanders didn't win. And I'm going to do it the way I want to do it. But our politics are different today because a member of Congress is more at risk of losing their primary than the general election based on the way the districts are drawn. So people go back to their bases. And that is going to be hard to change. But think about his coalition of the progressives who hate Donald Trump, all the way up to moderate Republicans who are like, I've had too much drama with this Trump guy. I need to tone it down. That's a good coalition to beat Donald Trump for president. But it's a really hard one to govern with. And it's a really big balancing act. But I am quite optimistic about where we are going as a country. Some of that is for the wrong reasons, but I actually think COVID got some excesses out of the way. It's going to allow for a stronger future recovery down the road, real income growth, real satisfaction with where we're going, and never bet against America. This is critical because China is posing a great threat to us. And it is so much commonality in the polling on how Americans feel towards China. And why that's important is because when we had the Cold War, before the Berlin Wall went down in 1989, is we had really hard fights on domestic policy, but we had something that binded us together. That was free markets and democracy and capitalism and human rights. And I believe we are going back to that in the face of this challenge over the next couple of years. China's making a huge mistake by coming after the US and poking us in the eye. You just need a unifier that can bring all of that together. And that's why I think America is poised for future greatness. And I think that while we've gone through these hard events in life, they've always made us stronger. COVID is making us stronger. All the events that are tough today, we're going to look back on and say that this made our society better over the long term, whether that's the innovation in the medical community, that's the focus on businesses and income and the unemployed. I mean, think about the stimulus we did. It was so well designed and so well timed while we were under the gun. Very different than the financial crisis. And everybody came together to get that done. And so that's why I look at it, I call them green shoots. Mm-hmm. And I think we're getting there. I just don't want people to think it's linear or, I'm being naive. There are going to be twists along the way. But I do think that we're headed in the right direction moving forward.
Well, I think it's 7:33, and I think that's a great note to end on. I can't thank you enough, Dan. This has really been an exceptional hour and a half, and To all our clients, again, thank you for joining us. We hope you enjoyed it. We will follow up with questions that we haven't had a chance to answer. And hold on to your seats. We have 6 days left. Thank you again.